Assalamualaikum, salam sejahtera pada saudara-saudari sekalian. Pada sidang akhbar ini, Bank Negara Malaysia dan Jabatan Perangkaan Malaysia akan menyampaikan taklimat mengenai prestasi pertumbuhan ekonomi negara pada suku pertama tahun 2016. Taklimat ini juga merangkumi perkembangan monetary dan keuangan. Pertumbuhan 4.2% ini dicapai walaupun pertumbuhan ekonomi di peringkat global menjadi lebih sederhana. Ini disebabkan oleh pengeluaran yang lemah di kebanyakan negara, perdagangan global yang lembab dan pasaran kewangan yang tidak menentu. Ladies and gentlemen, as forecasted, the global economy experienced a slow start to the year. Production was weak in many countries, global trade remained lackluster, and financial markets experienced high volatility, altogether resulting in a more moderate growth performance. In the advanced economies, growth continued to be modest. In Asia, economic activity expanded at a more moderate pace, partly because of weak exports. Amid this development, policymakers undertook more stimulus to support growth, which include increasing the usage of non-conventional monetary policy in several major economies and expansionary fiscal policy in People's Republic of China. The Malaysian economy recorded a growth of 4.2% in the first quarter of 2016. The preceding figure was 4.5%. The slight moderation in growth mainly reflected global developments and cautious spending by the private sector. Despite moderate global growth, the Malaysian economy is expected to remain on a steady growth path of 4 to 4.5%. We expect growth in 2016 to be supported mainly by private sector spending, as the impact of GST and price adjustment lapse. Measures by the government aimed at increasing disposable income will also provide further support to growth in the second half of the year. Let's look at the data on the supply side. The services sector recorded a sustained growth of 5.1%, supported by growth across all subsectors. The manufacturing sector expanded by 4.5%, backed by the continued expansion in both export and domestic-oriented industries, although at a slower pace. The mining sector growth turned around to record a marginal growth of 0.3% due to improvement in production of natural gas. The agriculture sector contracted by 3.8% as the El Nino led to a lower production of palm oil. Growth in construction sector remained strong at 7.9%, driven mainly by the civil engineering subsector, which more than offset the weak performance of the non-residential subsector. In terms of contribution to growth, in the first quarter of 2016, the private sector activity remained the major driver of growth, contributing 3.2 percentage points to the overall expansion. External demand contributed negatively to growth, minus 1.2%, following a decline in real exports of goods and services amid continued positive growth in the real imports. Going by the component of domestic demand, private consumption expanded by 5.3%. Household spending was supported by continued wage and employment growth. Wages in manufacturing grew by 6.9% and continue to be supported by export-oriented industry, while the unemployment rate was higher at 3.4%. Total employment remained sustained at 14.1 million person compared to similar numbers in fourth quarter of 2015. Household spending increased on food and beverage and communication services. In addition, there was also higher spending on utilities such as electricity and water due to the hot weather during the quarter. Retrenchment and layoff have been very much company and industry specific and are not a generalized phenomena. As such, jobs gain remain positive as reflected by indications such as sustained job postings, particularly in services sector, and the continued wage growth. Private investment growth moderated to 2.2% in the first quarter of the year. A significant part of the moderation was attributable to adjustment in the upstream activity in the oil and gas sector. Cautious business sentiment under the current economic environment also led to some slowdown in the investment activity. By type of investment, growth was also dragged by the lower spending on machinery and equipment. However, investment activity remained supported by higher spending on structure as well as continued progress of long gestation projects, especially in the manufacturing and services sector. It should be noted that forward-looking indicators such as investment approval and FDI continue to remain healthy, suggesting higher growth of capital expenditure as we move forward. Let's look at the current account numbers. Gross export grew at a slower rate of 1%. Growth was supported by the continued expansion in manufactured export, such as electrical and electronic and non-electrical and electronic products. However, growth of commodity export recorded a larger contraction. Growth of gross import recorded a marginal decline of 0.4%, mainly because of slower growth of intermediate and capital imports. Growth in consumption imports remained strong, driven mainly by food and beverages and semi-durable goods such as clothing and footwear. As a result, the trade balance recorded a surplus of 24 billion ringgit during the first quarter of 2016. The current account in our balance of payment recorded a surplus of 5 billion ringgit or 1.8% of GNI during the quarter. This was supported by a continued surplus in the goods account and smaller deficit in the income accounts. The services account deficits was larger as foreign services continued to be utilized for domestic investment and production purposes. Let's look at the performance of the ringgit. The ringgit has strengthened in 2016 amidst a resumption of capital inflows. As a result, the ringgit has appreciated against major and regional currencies. The ringgit appreciated by 5.9% against US dollar. Overall, the ringgit, NEER and REER have also appreciated by 2.7% and 1% respectively. Despite the recent strong performance of the ringgit, uncertainties in the external environment could lead to volatile conditions as we move forward. Despite current expectation of a slower pace of interest rate increase by the Fed, this expectation can change dramatically. Adjustment in China may continue to raise growth and financial market concern. Crude oil prices will remain volatile. because of uncertain supply and demand condition. Notwithstanding the capital flows and ringgit volatility, Malaysia's economic resilience, including the country's strong external position, sustained economic growth, low inflation, and sound financial system will support the ringgit over the medium term. Let's look at the Malaysian bond market. The non-resident holdings of Malaysian government bonds have been relatively stable, hovering at around 31% of the outstanding value of government bond, or 187 billion ringgit as at end of March 2016. The majority of the investors in the Malaysian government markets are long-term investors, mainly asset managers, central banks, and pension funds. Our international reserve continue to be supported by inflows from trade and foreign direct investment. As at 29 April, international reserve amounted to $97 billion. This represents a $3.7 billion increase from the low of $93.3 billion as at the end of September 2015. But most importantly, international reserves are more than sufficient to facilitate international transactions. The reserve level is sufficient to finance 7.9 months of retained imports and is 1.2 times short-term external debt, higher than international threshold of 3 months and 1 time, respectively. Malaysian external debt remain manageable. The external debt stood at 809 billion ringgit in the first quarter of 2016. Malaysia's foreign currency denominated external debt to GDP in the first quarter of 2016 is low at 39.9% of GDP. And if we contrast that against the period of the Asian financial crisis, which was at 60%. When ringgit denominated debt held by non-resident is included, the level of external debt stood at 65.8%. However, the portion of debt underscores the high participation of non-resident in our financial market and very much reflective of the depth and breadth of our bond market itself. Given that 59% of total external debt has medium to long-term tenure, rollover risks are generally limited. Moreover, about 70% of our short-term external holders are banks, reflecting the greater regional outreach by our domestic banking institution overseas. The liquidity and foreign exchange risks arising from these activities are prudently managed by our banking sector. Let's look at the inflation numbers. Headline inflation was higher at 3.4% in the first quarter of 2016. This was mainly due to smaller negative contribution from the transport category compared to the base in first quarter of 2015. Inflation in the housing, water, electricity, gas and other fuels category also increased during the quarter following the reduction in electricity rebates in January 2016. Core inflation moderated slightly amidst the slower expansion of domestic demand. From second quarter 2016 onwards, inflation is expected to moderate given the lapse of the GST impact and the more moderate domestic demand. The Monetary Policy Committee maintained our overnight policy rate at 3.25% at the most recent MPC meeting on 9th of March 2016. Our next meeting will be next week. Economic growth is expected to expand in the region of 4 to 4.5% in 2016, with domestic demand being the key driver of growth. Inflation is projected to range 2.5 to 3.5% for 2016. At the current level of OPR, the stance of monetary policy remains accommodative and supportive of economic activity. Let's look at the liquidity of the system. With the reduction in the statutory reserve requirement effective 1st of February 2016, the pressure on interest rate in the interbank market has eased. The reduction in the statutory reserve requirement resulted in a broad-based release of liquidity in the banking system. Following this, greater interbank lending was observed, which improved the distribution of liquidity amongst banks. Year to date, the 3-month CLIBOR has decreased by 17 basis points from 3.84% to 3.67%. On domestic liquidity and funding condition, it remained firmly supportive of financing activities. Aggregate surplus liquidity of the banking institution placed with Bank Negara Malaysia remained high at 177 billion ringgit, preserving comfortable buffers against adverse liquidity shocks. The banking system liquidity coverage ratio stood at 126%, with all banks recording levels well above the current minimum regulatory requirement of 70%. Banks continue to maintain a stable and more diversified funding structure through the issuance of medium-term ringgit and foreign currency funding instruments, which grew by 13% annually as at first quarter 2016. Taking into account the broadened funding base of banks, which captures the effect of financial deepening, bank loan-to-fund ratio improved to 82.4% during the quarter, while the loan-to-fund and equity ratio remain low at 73.9%. As you can see, we don't use much the ratio on loan-to-deposit ratio anymore, simply because our banking sector have basically diversified the funding base and our system have become more sophisticated. Let's look at the financing data. Financing continued to be channeled to the private sector. The growth in net financing from banking system and the corporate bond market continued, but moderated to 7.6% during the first quarter of 2016, reflecting slower economic activity. Importantly, borrowers with the capacity to service their debt have continued to have access to financing. Loan approval rate for businesses has been stable, while financing has continued to be channeled to eligible households. Level of loans disbursed to both businesses and households was sustained during the quarter at 262 billion ringgit. Borrowing costs for the private sector remain stable. In particular, lending rates to businesses and SMEs remain below their long-run average. The domestic financial system remained resilient against rising risks of spillover from a weaker global growth and persistent volatility in the international financial and commodity market, while domestic risks more broadly have continued to moderate. More challenging business conditions and rising costs will likely weigh on the revenue and loan performance of financial institutions in the period ahead. All this trend requires close vigilance. Any adverse development are expected to remain well within the loss absorption capacity of our financial institution, given the healthy capital buffers. Our capital buffers strengthened further to 170 billion ringgit at the end of first quarter 2016. The growth in overall household debt continued to moderate to 6.5% or 89% of GDP in the first quarter of 2016. Housing financing remained robust, expanding by 10.7% amid sustained demand for affordable housing. Generally, prudent debt service ratio continue to be observed by both bank and non-bank for new household lending. This has led to improved quality of new financing to household and preserve the overall household resilience. Indicators of the quality of household loan performance remain steady, with the share of impaired and delinquent household loans at 1.7% and 1.4% of total household borrowings, respectively. Higher impairment were observed among households that are already financially stretched and more reliant on variable income sources. However, this has not translated into a broader decline in the overall performance of household loans. Business sector borrowing expanded, even though at a slower pace of 8.8%, in line with the moderation of the domestic economic activity. Growth in financing to SMEs remained robust at 9%. Outstanding external borrowing by businesses amounted to 287 billion ringgit, lower than the previous quarter on account of sustained healthy repayment and the strengthened ringgit. Risk from banks' exposures to business sector remain contained. Most businesses continue to maintain healthy debt service capacity, and they have the necessary comfortable liquidity buffers. The aggregate leverage of Malaysian businesses, as measured by the median debt to equity ratio, improved to 44.5%. If we look at the corresponding figure in third quarter 2015, the ratio was 46.8%. The median interest coverage ratio, while lower, remains well above prudent levels at 4.4 times. Correspondingly, the ratio of impaired and delinquent business loan was broadly unchanged from the previous quarter at 2.6% and 0.3% respectively. Let me conclude on the presentation. The moderation in growth is assessed to be temporary following the successive shock experienced by the economy and the critical structural reform that were undertaken to put the economy on a stronger footing as we move forward. The outlook for 2016 for the Malaysian economy remain on a steady growth path of 4 to 4.5%. Growth is projected to improve in the second half of 2016, driven by 1. Higher production in the manufacturing sector from added capacity. 2. Improved commodities production from the diminishing effect of El Nino. And 3. Higher wages for civil servants and upward revision to minimum wage. Malaysia's macroeconomic fundamentals remain resilient and will enable us to manage the prevailing challenges in the global and domestic environment. This is reflective of the diversified, strong and resilient nature of the Malaysian economy. I have an announcement to make on the formation of a financial market committee. Bank Negara Malaysia is pleased to announce the establishment of the Financial Market Committee. The committee is established with the objective to broaden industry engagement with a focus in reviewing and formulating comprehensive strategies for the wholesale financial market to meet the diverse and complex demand of a more developed and internationally integrated economy. The committee shall comprise of participants representatives from the central bank itself, financial institution, corporation, financial service providers, and other institutions or stakeholders which has prominent role or participation in the financial market. The committee also aims to provide a senior level forum for market participants to meet regularly to discuss matters and potential issues and risks relating to the development of the Malaysian financial market.